Hey everyone, we appreciate you joining us today. We've got a great session. We really appreciate you joining us. We've got two experts, Glenn Lazovic and Matt Cox from First Home Mortgage. We're getting a lot of questions these days from home buyers, from agents, and we really think this topic is going to be well received. I'm Mike Rival. I'm the principal broker for Realty Advantage. And Chris, you want to introduce yourself?
Sure. I am Christine Gray. I am the Director of Sales here at Realty Advantage. I've been here about 25 years, believe it or not. And Hope Arias is our branch manager. She's been with us for over 20 years. So she's awesome, just not with us today.
Yeah. So if you have any questions about real estate, feel free to reach out to any of us if we can be of assistance. These are our two esteemed guests today, Glenn and Matt. I've had the pleasure of working with Glenn for about 25 plus years there. So if you guys could introduce yourself as well, appreciate it.
I'm Glenn Lazovic with First Home Mortgage. I have just started my 37th year in the business. And Matt?
Yeah, and I'm Matt Cox. I've been with First Home for a couple of years with Glenn, and not in the business as long as Glenn. About 5 years in the industry, but happy to be here and happy to help explain some stuff to you.
Fantastic. Well, again, we got a lot of information to get through here. We're going to get through mainly three topics for everyone here today, and this is intended for home buyers as well as agents. First thing we're getting is a lot of misinformation and confusion out there about interest rates. Everybody was excited as the Fed made their announcements of upcoming rate cuts. And a lot of home buyers and some agents are actually confused about the difference between the Fed cuts and the mortgage rates themselves. So we're going to chat a little bit about that. Then we'll get into some amazing tools that First Home has for doing payment comparisons for your home buyers. And then we'll get into the topic of the seminar, which is understanding what it really costs of waiting as a home buyer. Chris and I actually just got off of another webinar where the economist for the National Association of Realtors was our host and went through this chart. So again, there is a difference between the Fed rate cuts that you see on the news and then mortgage rates. So mortgage rates have been creeping up recently, and that's what's causing a lot of the confusion between for a lot of home buyers out there. So Glenn, if you don't mind, maybe chat a little bit about this.
Sure. So when you hear the Fed cutting interest rates, the rate that they're talking about is not mortgage rates. It is the short-term overnight rate that the Fed lends to big bank clients. That affects things such as prime, any loan that's tied to prime. So some student loans are tied to prime, credit cards are tied to prime. The mortgage rates are long-term rates, whether it's 15 years or 30. Those are really closer to the 10-year Treasury. And if you notice the 10-year Treasury, the yield on that has gone up recently. Those rates, the mortgage-backed securities, the 10-year Treasury, those are going to be tied to inflation. So if there's a fear that inflation is going to tick up or it's not going to continue to come down, those rates are going to go up. We have a new administration coming in, and I think right now, until we see what's going to go on with that, that's where there's some inflationary fears, and that's what's causing the rates to go up right now.
Right, appreciate
And when
that.
I say the rates to go up, I'm talking the long-term rates, mortgage rates.
Well, thanks for filling that in for us, Glenn. We're going to jump over the screen now to a tool that they use for working with home buyers as far as their financing options.
So this is a tool that we use to present to buyers before they sit down with the real estate agent or right afterwards when they want to get a feel for the cost, not only the cost to get in, the cost to close, but also the monthly payments at different sales price amounts. So what we did here is we took 4 different sales prices from $650 to $725. Typically, a borrower is going to tell us, they're comfortable. They want to spend between $650 to $700. We want to go a little bit over that in case, not to push them, but to give them some comfort in case they see something a little bit more or there's a bidding war. So as I mentioned, we have 4 different sales prices from $650 to $725. The loan amount, for this example, we assume 10% down payment. You have your interest rate shown here, your APR, which is your annual percentage rate, that factors in some of the closing costs, and we'll get into that in a little bit. Your term of the loan, this is a 30-year fixed rate loan, and we assume 0 points. This is your in comparison of your monthly payment. And if you look over here on the right, you'll see the payment difference. So at 650, these are all compared to the 650. So at 675, it's $184.63 a month higher than if you bought a 650 property. $369.26 if you bought a $700,000 property, and $553.88 if you bought a 725 property. So you can see how those payments affect you. Your tax benefit, keep in mind, this is an approximate. Highly suggest and recommend that you talk to a tax professional. I am not a CPA and I am not a certified tax planner. This is a ballpark. And again, for actual tax benefit, please check with a CPA or a tax advisor. Your cash.
One thing I'd like to just kind of note for everyone is I think the ease and beauty of this is that Glenn and Matt can just send buyers a link. They can pull it up on their screen from the comfort of their home, and that's what we're doing right now. And then remotely, Glenn can put in any scenarios that the buyers may have questions about. So it's great to be able to see this side by side, but it is dynamic. So he can actually make those changes so that the buyer can actually see the changes on the screen.
That's correct, Mike. Thanks for pointing that out. So here's your cash to close, and we're going to take a deeper dive into that in a minute. Again, your monthly savings, and over here is your savings over 60 months, which is 5 years, and the interest and mortgage insurance paid. And yes, this, because you're putting less than 20% down, this would require mortgage insurance premium. So let's take a little deeper dive into a couple of aspects of this. And to do that, we go to this more info tab over here. We're going to click on that, and you'll see this chart come up. First tab is your payment breakdown. Then we have closing costs, reinvestment. We didn't fill anything out in the reinvestment, but that's really neat if you want to see how you can invest the savings between 2 different programs, or if you want to prepay your mortgage, and that will speed up the time to completion. But we didn't put anything in that at this point. So let's go back to the payment breakdown. And again, you have your 4 price ranges up here. Your P&I is your principal and interest. And that's shown right here. And you have basically four factors of your mortgage payment, your total payment. We refer to that as PITI, principal, interest, taxes, and insurance. So first component of that is your principal and interest, your property taxes. In this case, these are estimated, as is your hazard insurance, which is the same as homeowners insurance. And as I mentioned, because there's less than 20% down, these loan scenarios would include mortgage insurance. So private mortgage insurance, that protects the lender should a borrower go into default. So here's your total monthly mortgage payment. And then below, I assumed a $65 homeowner's HOA fee. And that is included here. So when you look at your total payment, this is your total monthly housing expense. Okay. The HOA fee gets paid separately to the homeowners association or management company. this really helps buyers get a good feel for the numbers in today's environment where you have to make quick decisions. You don't want to think about the cost overnight, or you don't want to sleep on it. Putting an offer on a house, it may be gone by the time you wake up. So this gives you a lot of information, and hopefully will make you more comfortable with the numbers. So, and as Mike pointed out, we had the ability to go over this with you remotely. You pull it up on your computer, I'll pull it up on mine, and we can make real-time changes as well as go over and highlight things. So with that, we're going to turn it over to Matt, who's going to talk to you about the cost of waiting.
So Glenn, appreciate that. Again, it's a great tool for seeing what your options are there. One thing we're getting also is a lot of feedback from buyers and agents that buyers are thinking about sitting on the fence, whether it be waiting for rates to come back down, or they think there's going to be a lull in prices. And just wanted to share some slides to make sure that home buyers have perspective into what's happening with our local market here in the DC area. Again, what's driving the price surges over the last couple of years has just been record low inventory. It's historically low. We're starting to see some improvement, but it's still extremely tight out there. So again, my personal opinion, I don't see prices coming back in our area. There's just still a ton of demand out there. Just year over year from December of 23 to December of 2024, we saw 11% increase in the median sold price in our area. So any buyers that were thinking that same thing last year, they're getting priced out. Another thing we're seeing is a uptick in pending contracts. So we're seeing more buyers come to the market. So we're expecting the demand to be very strong into 2025. So that's what kind of leads us into our last segment here, is the cost of waiting. If you're a home buyer out there thinking that, hey, I might wait a little bit longer because I'll come out ahead either with my mortgage or with the home prices, we want to make sure that you're informed of what's happening in our market. So I'll turn it over to Matt at this point.
All right, thanks, Mike. That was all great, important information. Leads right into this new analysis that we have put together for you, just on the cost of waiting and why buying now might actually save you money, even if rates come down in the future. So in this scenario, we've put together a few different options here. This first column will show you every number that goes into buying your home now at a basic scenario price of $650 purchase price. We've put a few other options in here showing you what if prices go up but rates stay the same. So that same home later might cost more. Let's see that scenario if rates stay the same and what that might look like. Then we also have a third column here showing what if prices go up and rates go up as well. So we can talk about that and what that might look like. And then this fourth column, what if rates go up, or what if prices go up and interest rates come down? A lot of people out there think that I'm going to wait for interest rates to come down because my monthly payment's going to be cheaper. I'm going to get into the home and save some money just because of interest rates. Well, that's not always the case, because even if purchase prices go up, and interest rates come down, your monthly payment might still be a little bit higher than if you were to get into the home today at a lower purchase price. Now, in the mortgage industry, there's this cliche quote, date the rate, marry the home. And that's definitely true. You can always refinance into a lower mortgage rate, but you can't change the purchase price. So that's where all these scenarios compared side by side might help explain the benefits to purchasing now, even if the rate's slightly higher than what you think it might be in the future. So let's go through these scenarios one by one and talk about what the numbers might look like. So in each of these scenarios, just for ease of use, we've done it at 20% down for each one of these. So let's say we're purchasing a home today at $650 purchase price. With 20% down, your loan amount would be $520,000. And with today's rate of 7 1/8. Now, the big thing we really want to focus on is what that monthly payment looks like. Because bottom line is that's the most important thing, what you're comfortable paying, what the monthly payment is going to look like in each scenario. And you'll also see the cash to close. That's down payment and closing costs together is this number here, a little over $153,000. Now, let's compare that to what if prices go up by an appreciation number of 8%? I know Mike had the stat up just now showing 11% appreciation, but we'll keep these scenarios at 8% appreciation. So now that same home, maybe next year, might be a $702,000. 20% down would leave your loan amount at a little over $561,000. In this scenario, interest rates are the same as today. But look at your monthly payment. You're paying $342 a month more than if you were to get into that home today. And your cash to close is significantly higher as well, about $12,000 higher. Okay, let's talk about that scenario. Prices go up and rates also go up. So now you're sitting at a purchase price of $702,000, loan amount $561. Now your interest rate went up about 1/4%, so you're at 7 3/8 now. What does that do to your monthly payment? You're a little over $4,700 a month now. That's $437 more than if you were to get into the home today. That's a significant amount of savings in my eyes. So that right there, the numbers speak for themselves. And your cash to close again is almost $12,000 more than if you were to get into that same home today. Now let's look at the final column here. What if prices go up and rates come down? That's kind of the best case scenario if you absolutely need to wait to get into the home. So you have your purchase price here at $702. Your loan amount again is $561,600. And now rates have come down a little bit from today's rates. So you're sitting at a 6 3/4 mortgage interest rate now. Let's look at the monthly payment. Your monthly payment, even with the lower interest rate, is going to be $201 more than if you got into the home today with the lower purchase price. And your cash to close is still going to be higher. So that really drives home that kind of cliche quote, date the rate, marry the home. If you're comfortable getting into the home today at this $650 purchase price, there's really no need to wait for a lower interest rate. You'd be paying more in your mortgage because of the appreciation, getting into bidding wars, any number of scenarios that could drive home prices up, which historically, year over year, you're not going to see home prices come down. So all of these scenarios are very accurate and will likely happen. So
Can I point something out too, Matt?
Yeah.
A lot of times people have said to me, hey, we want to save some money to get into, we'll have more money to put down or more money for closing costs. So, how much would you be able to save? And they say, well, between $500 to $1,000 a month. Well, as Matt pointed out, even if they save $1,000 a month, the closing costs, the cost to close is $12,000 more, which they just break even on that. So
exactly, that's a good point. Yeah, if you're looking to save money to get into the home, it still might not be worth it because you wouldn't break even with the home prices going up. So
I feel like that's why this tool is so valuable, and it's so great that you guys do this for your clients, because you can really see the different scenarios side by side and weigh those options before you commit to that decision. If they don't talk to you first, they might not know that they're not really coming out ahead.
Yeah, exactly. And we're always happy to run more specific scenarios. If somebody's looking in, let's say, in DC or Frederick, those appreciation numbers might differ a little bit. So we can always cater this to the specific scenario and update these numbers in real time to go over it in the most accurate way that we can. Just to drive home the point that each scenario is a little bit different, but the numbers speak for themselves.
Yeah, this is great, like Chris mentioned, as far as being able to see the different options here, and really can't stress this enough. We have seen this come up over and over again with countless buyers over the last probably 2 to 3 years. People waiting for various reasons. But it's important that if you think you're going to end up on the other side, again, what we're dealing with here is a housing shortage. There's just simply not enough inventory out there for the number of families in the area. Population's growing up every day. A lot of people refinanced back post-COVID, so there's a shortage of inventory there. So this is a great tool, and again, I would encourage everyone to reach out to Glenn or Matt. They're happy to do this scenario with you remotely. They can customize it to your needs, to what you're thinking about there. It makes people very comfortable on the buy process, because as everyone knows, it's a very competitive market, and I think 2025 is going to continue to be competitive. Again, we appreciate everybody joining us today, and I really appreciate Glenn and Matt, taking time out of their day to help us with this. If you have any questions for them, contact them directly. And again, Glenn, Matt, anything you want to add?
Just, I always say there's no silly questions, so please reach out to us. Matt and I work together as a team, so either Matt or myself. We're here to help you, and we're here to run the numbers for you. And there's a lot of other scenarios we can do for you. So, if you want to compare two houses you're thinking about buying, we could run a scenario for that. If you're thinking doing a 15-year versus a 30-year mortgage, we could show that as well. So reach out. We're here for you. And Matt?
Yeah. Yeah, no. If you're an agent looking for information for a client, we can specify these scenarios for you. Or if you're a buyer that wants to talk through different things, just feel free to reach out to us, and we can kind of tailor this to your specific situation.
Thanks, everyone. Appreciate your time, and have a great day.
Great, thank you so much.
Take care.